Edmund Shing, you write a hyper-pro, hyper-detailed research note. How do you write a note now on the Greeks for pros that have missed this great bull recovery?
Yeah, it's a little bit depressing at the moment because you say it's a great bull market recovery, except if you're long vol, in which case you've been crushed, of course.
Yes.
But what it does suggest, Tom, it's interesting, when I have conversations with investors, as I did last week, most, in fact, all institutional investors I spoke to were very cautious still. So on the one hand, you might say we've had this great bull recovery since the end of last year. On the other hand, I would retort and say, well, that's all very well, Tom, but investors have not loaded up at all. In fact, fund flows have continued to be more or less out of equities rather than into equities, at least on a cash basis. So that tells me this is somewhat fragile, and it also tells me people have not participated. So the way I would play it right now is say, look, stay long or even go longer, but also take advantage of the very low implied volatility levels in equity markets to do some out-of-the-money hedging. You know, buy some of those out-of-the-money puts to hedge your long positions right now.
Where is normal VIX? Not a couple weeks, like 10 weeks ago, maybe 8 weeks ago, there was this idea of a new reset on VIX at the 9, 10, 11 that we saw would become 12, 13, 14. And all of a sudden we've come down in this calmness of this market, as you say, Mr. Shing, to a lower number. Are we still in the same VIX parameters, or have you adjusted your set on that?
I think generally we're pretty much in the same volatility regime, Tom. The big overriding driver remains liquidity more than anything else. And we know from central banks, from what the Fed have said, and even what the ECB have said, we know that liquidity is going to remain somewhat plentiful. And that's what keeps depressing implied volatility. The fact that liquidity is plentiful. And until that changes, because you're right, at this point of the economic cycle, I would normally say with a positive output gap in the US, structurally implied volatility should rise. However, while the Fed continues to put on its liquidity act and even end quantitative tightening, I think that will be delayed.